Hi everyone, hope you're all doing well. Something a little bit different for you guys today. We have a video to check out. Now this is going to be a bit of a reaction video, and this comes from the YouTube channel Everything Money. Now I'm sure most of you guys are aware, this is not my most favourite channel in the world. In fact, I'll definitely put it in one of the categories of the least reliable YouTube channels out there at the moment. And you guys know my opinions on these. I think that when you look at what they're doing at the moment, I used to actually be a big fan of Everything Money. When they first started, I really liked how they had a process. This is our process. We see if these stocks fit our category. But since then, they have, I think, lost the way a little bit. They're selling their program, which is something like $400 a year, which is just insane. I have people that complain that my Patreon's expensive at £5 a month. I'm like, that's cheap compared to what a lot of other people are putting out there. And yeah, I think that they're more of a sales channel at the moment, and obviously trying to get people to pay overpriced group that you get a bit of a DCF that you can make yourself in Excel, which I think is absolutely ridiculous. I don't like how they now preach that they are better than everyone else, even though you look at most of their picks that they've had in the last year, something like an Intel, for example, which has been absolutely crushed down 41%. And this just proves that you can be a value investor, but you can still take massive losses and you're not better than everyone else. And you can add many stocks to this list, the likes of Sleep Number, Walgreens, Alibaba, the list goes on. So I don't like that about them as well. But what we have to get into the actual point today, what we have is a reaction video, and the reaction video is going to be on DraftKings. So DraftKings is covered. I'm looking forward to this, and without doubt, it's going to be a bearish view on DraftKings. So what I really like to do is when I'm investing into a stock, and you guys know I'm a big bull on DraftKings, is I like to see a negative viewpoint from DraftKings just to make sure that I'm seeing everything. I'm not kind of going in with rose-tinted glasses, just focused on the positives. I like to hear the negatives, and if there's some serious negatives, then I can look back on my pick or my buy of DraftKings and go, oh, I never thought of that. Maybe I should actually reduce my position, or, oh, that's actually a really big negative. I should maybe sell out the position. Or I just look at this and go, yeah, that's not true, because actually when you look at this, that is not an issue in the company. So yeah, I think it's always good to kind of hear a negative view rather than just focus on the positive. And we'll see what these guys say today. So let's get started and see what's going on here.
Nowhere. As a shareholder, they don't realize this stuff happens. Because at this point, everybody knows you. Right. They were the new crypto. That's really the idea behind DraftKings and FanDuel.
Okay, this is going to be a different level if they're comparing DraftKings to crypto. This is going to be a good one.
The world of online gambling is exploding, Mo. Guys,
Super Bowl told us that.
what
Commercials?
Oh yeah.
They were the new crypto.
I was gonna say, I hope it doesn't end up like crypto of 2022.
Yeah.
So guys, I think when I look at this,
I'm sure DraftKings have had the Super Bowl last year as well, and if it's your main event, 100% you're sticking an advert on the Super Bowl. 100% you're getting clients on that day.
feels a lot like the .com era, where every company is just trying to spend whatever it takes to get users, and we have some more data on that with DraftKings. We have a fantasy football game called Dynasty Owner. Dynasty Owner, and this is perfect for our viewer because it's, our viewers are 96% men who love sports. So if you like fantasy football, check it out, dynastyowner.com. But we got killed in the last year trying to get users because everybody said, well, we're getting a ton of money from these casinos that are guaranteed money.
Right.
It sounds a lot like the crypto of like, listen, just pay to get it. It's all.
I'm not sure by casinos if he's actually referring to DraftKings, but I 100% agree. Not as much now. If you actually look at the marketing spend of a lot of companies, including DraftKings, they are really starting to pull back the marketing spend. But I agree, 2018, 2019, 2020, especially because capital was so easy to get for a lot of these businesses, there was a lot of get users at all costs. And because the big thing is that none of these companies now, or if you look at a lot of these sports betting companies, a lot of them have gained the users now, and they're starting to pull back the marketing spend. And now a lot of the states that they did that big marketing spend on, they've got the market share now that they can pull back the spend and actually make profit. So if you actually look into a lot of the businesses now, they've kind of done the big spend and moving into the profit, which is, I think, important to say, which at the moment they're not saying. And the big thing is that when you have it, the US coming to online sports betting is massive. One of the biggest economies out there in the world that has only just allowed sports betting in 2018 is absolutely massive. So the big thing is that a lot for DraftKings and FanDuel, the big giants that are out here, they wanted to get big market share, so they control most of the market, and that's what they've done. I think between DraftKings and FanDuel, I think they can control 80% of the market. And the thing is that when they control all the market, because they've taken all the users on, that anyone now that wants to try get into the space can't get into the space because the users are already on them platforms. And that was the whole reason for the marketing spend. Now that they've got into a point of view where they're maturing, they can actually pull the marketing spend now, where they're actually, if you look at DraftKings, for example, they've got 11 states that are profitable. And now because there's them profitable states now, you're starting to see the losses come down, which at the moment has not been said, which is what I would say straight away to that point.
About who can grow the fastest in this market. That's always a concern. DraftKings and FanDuel are the biggest ones on the street, right?
Oh, yeah.
Yep.
Now, DraftKings has been hurt. It hit an all-time high on March 22nd of 2021 at $74.38, according to our site.
Tell me, you can make a long list of growth stocks that have been hurt through 2021 to 2022 to 2023. There's a long list.
And it has fallen as low as $9.83, but it's rebounded now to $20.54, a big increase on Friday.
Because of earnings, yeah.
Now, here are some interesting things about DraftKings. You ready? They brought in $1.9 billion in revenue, lost $1.5 billion on that $1.9.
Those are the old numbers there. So a little bit slower there. If they actually look at the recent numbers, you'll be able to see that the losses are coming down and the revenue is still going up. So, okay.
Free cash flow last year was a loss of $770. Why? Trying to get users. Gross margin, 33%, not bad.
It's actually going up, that gross margin, if you actually look on the recent quarter. So once again, a bit of outdated numbers. Also, it's key to say that if you actually look at the long-term gross margins, the long-term gross margins this year are actually projected to get into that 40% range. So that's why it's really important to not look. There's no point using them past numbers because they're done. You know, a big thing about investing is looking at what they're going to do in the future, looking at past numbers, especially numbers that aren't even right now up to date. You know, if you even look at them numbers that have just recently come out, you can see the improvement in DraftKings, which is automatically, great.
Bad. Bottom line. So guys, again, why are you investing? You're investing in this if you really believe that this thing is going to crush it long term. Right. But Mo, here's
so online sports betting only just come active in 2018. The market is only 48% at the moment out there. So there's still 50% of the market to potentially come online in the next few years. DraftKings, FanDuel, control most of the area because they've spent so much on sales and marketing now. 100% it's going to be, when you're from the UK, you can see here that this area is going to be massive and there's going to be winners. We know it's going to be a successful area because you only have to look at the rest of the world. It's just the US has been so slow to allow it. It's going to have a massive boom in the next few years.
Part for me,
guess, by the way.
What was that?
And it's a guess.
Correct. $9.2 billion market cap, 10.6 enterprise value. The difference here is essentially the debt. Mm-hmm. That's not a ton of debt for a company, but it is a ton of debt for a company.
Not too bad on debt.
Well, maybe not. So let's go look at their shares.
They've got a lot. They have got a bit of debt, but they've got loads of cash as well. Key to think about.
So guys, when a company has losses, they can cover those losses in two ways. Issuing debt or issuing equity, which is issuing more shares.
Yep.
The downside to issuing debt is you make the balance sheet worse. The downside to issuing shares is you dilute people. So back in 2019, they had 312 million shares outstanding, and this last reported quarter before the updated numbers, 448 million. That is huge dilution.
Oh, now that is key of someone that hasn't done research into a business. If you just stare at them numbers and you haven't done a little bit of research into the business, then that's a massive error. So let's just get the shares outstanding by DraftKings up. So obviously DraftKings came through the SPAC here, and then obviously they did a bit of a share increase raise to get capital because the shares were at an extended value. Absolutely fine with that through 2020. Now, if you actually look from a relative point where they'd come onto the market, the company was stable, we were at about 400 million shares from around about November 2020. Now, from that time frame, from nearly 3 years ago now, you can see here the shares have gone up by around 60 million shares. So there has been some share price increase. You're talking around 10-15% of shares outstanding increases, which is a little high, but you are going to see this in growth companies, and it's not terrible from this point of view here. Now, the big thing is you'll be able to see one of the major issues is this jump here. You'll see there's actually a major jump in the shares outstanding here. Why is there a jump in these shares outstanding here? Well, if you do a little bit of research, you'll be able to see they actually acquired GNOG. GNOG was a really good acquisition, got Tillman Ferreira on the board, lets them go into the casino market, the online casino market, and they actually did this at the right time, because at the time when they did the share offering or the share dilution is when the shares were quite richly valued. So they did this at exactly the right point. So actually, when you take the acquisition out, and if you go take the point of view from when they came on the stock market, the shares have only increased around about 5-10%, which isn't terrible for a growth company like this. So it's one of the things that I've had is that the shares outstanding does increase a little bit. I don't like that as well. But to exaggerate the point is not fair, because you've exaggerated it through when they've come onto the stock market and that they've made an acquisition, which is really key, because the acquisition was a really good price paid and a company that is really going to help them going forward.
If their shareholders don't care, which clearly they don't, then it's fine.
Well, I don't think
That's the great way for them to go.
right. I think the issue is that they don't realize this stuff happens. Right?
That's exactly right. Yes.
People that we always call the share dilution the silent killer for investing, because people don't realize it's happening. So as an example, this is a very important example to explain to people, because we're one of the few channels that talks about this. Let's say you have a company that makes $10 a year, okay, and it has 10 shares outstanding. Each share gets $1 of profit. Very simple. 10 divided by 10. Now let's say the company grows and makes $15 a share, $15 total. But they also issue 5 more shares. Guess what?
You went nowhere.
The company went up 50%. You went nowhere as a shareholder.
Yeah.
That is the problem with diluting owners.
And the issue with this is that they've used an example here where it's gone up 50%. We've just shown here, when you look at the company itself, realistically the shares outstanding have only gone 5-10%. So this is an extreme example to put DraftKings down when it isn't this situation here. So they're making it look a lot worse than what it actually is, which I think is a bit unfair.
There's a lot of value investors out there who will look over 10 years, and if there's any shares higher than it was 10 years ago, they avoid the company. Now, I will say this though. Here's the reason why shares going up is okay. If the company's so ridiculously overpriced, I'd rather take on more shareholders as a company saying, listen, why should we issue debt that as the company stock falls, if we borrow $1 billion...
And this is exactly it. There was the IPO or through the SPAC, and then there was a capital raise because the share price had gone so high, which is absolutely amazing. And then that was the right decision to do. You might as well get easy capital. And what he is saying here is that obviously when you've got a really good acquisition and your share price is high, it makes sense to do that through a share offering. So a little bit of research there would have connected the dots and go, okay, we can understand why there's been a couple of share offerings.
The company stock falls, we still owe that billion. However, if we issue $1 billion in shares at a really high valuation, if the stock falls, doesn't matter to us.
Yeah, we're good.
We don't owe that $1 billion. Right. It's just stock has fallen. And that's also why a good value investor wouldn't want that kind of company, because it just shows they're they're issuing shares only because the stock is so insanely high. Mo, when we see a company buy shares back, what do we want to see from the company in terms of valuation?
Buying them back at cheaper prices.
Right.
Of the company's stock. We don't want them to be buying when they're trading 100 times earnings or something like that.
Right, because when a company is buying back shares, they're essentially investing in themselves.
Right.
Doesn't matter if it's their shares or not their shares. So when they're buying back their own shares that are 100 times earnings, for example, they're basically investing in a company that's 100 times PE. Is that a good thing? Probably not. All right. Now, when it comes to DraftKings, let's go to the 8 pillars. Not really much to really look at, because there isn't 5 years of data. Plus, they have no return on invested capital because they don't make money, blah, 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 blah. This is a company that if you want to buy, you're hoping for this killer number. This killer, hey, this is going to go great, DraftKings is going to kill it, blah, 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 blah.
That's really all it is.
That's all it is. Okay, now one of the things we're going to do different on this channel is for a few companies, as we make their individual videos, we're going to talk about a few data points that support the bear case and the bull case. Now, here's the first bear case that I'm going to give. Their customer acquisition costs have absolutely skyrocketed last year. It's up 23% year over year from 1606 to 1976 per year.
So, with this point here is that the costs have gone up slightly this year, but when you look at the actual revenue growth of the business, the revenue growth is actually outweighing the increase of sales and marketing. So they may be spending a little bit more on acquiring customers, but what they're getting back in is a lot higher than what they're spending. This isn't a company being funded by sales and marketing, which is key to say.
User. So this means they're paying almost $2,000 last year to get a new user. With that in mind, that means that they have an idea of what their user is going to generate them in profit over the lifetime of that user. It better be over $2,000 per user.
So this is once again why it's really important that you don't just stare at numbers, because if you actually dig into the numbers, you'll be able to see that when DraftKings look at what they're doing, if you look at the moment, the states that they have currently have been in longer and they start pulling back the sales and marketing, they've gone from them states contributing profit of 100 million up to 500 million.
Right, and that's their goal, and it might very well be. But that is the reason why us at Dynasty Owner got hurt. Because that big cost to increase to get a user made it hard for us to get a user for our own game. Mm-hmm. Now, another bear case. The monthly unique players have slowed to about 611,000.
Oh, no it hasn't. It's increased in the last quarter.
Which still sounds like a lot, but the problem is the monthly users have decreased while the cost to acquire users increased.
Oh, misinformation overload. No.
That occurs as the company becomes more and more popular, right? So DraftKings and FanDuel, everybody knows them. So in order to get new users to sign up, you got to spend a lot more money. It's not like it's a new game. It's kind of like...
No. There's 42% of the states online. So every time they launch a new state, the aim is to get their new states to come into DraftKings or FanDuel, and then they stick in that platform for the lifetime. And then the more they stay on the lifetime, they bring back the cost of the sales and marketing, and then they generate profit in that state. So if you look at the states that have been historically launched by DraftKings, all the states from 2018, 2019, 2020 into 2021, now all them states are now making profit. So that's the whole plan. It's when states come online, marketing, get them in 2 years' time, that state then turns profitable as they pull the sales and marketing away. That's the whole aim of it.
Like when you have the start of a company, you kind of look at it like this. Nobody knows about you, so your cost is going to increase, and then as time goes on, it decreases, but as more and more people know about you, you get saturation, it costs more and more money to get an individual user. Because at this point, everybody knows you.
Right.
So to get more and more users, it's going to have to, and you have to spend
No. Oh my days. No, because when the states come online and they're able to go on the sports betting apps like FanDuel and DraftKings, that's where the new users are. There's 50% of the US still to come online. There's still, I believe, 60% of Canada to still come online. So they aren't saturated. They are not trying to get users to come onto the platform. The users can't come on the platform because it's not allowed in their state. So that's where the user growth comes from. There is no way near saturation.
More and more money to make sure you get the outliers really playing, right?
Yep.
So when you combine that with less people using, that's a big concern of mine for the company. Big concern. Now there are some positives. Mo, why don't you talk about some points of this story?
So online gambling makes up 50% of casino revenue.
That's incredible.
That is absolutely incredible. And DraftKings alone has about 23% of that. So there's 3 or 4 other companies that make up the rest of it. They make up, I mean, this is an oligopoly. It's incredible.
Yeah.
There's a big difference here between, and I feel like they are not stating this enough, there's the online sports betting revenue and there's the online casino revenue. There's 2 big difference there that is 2 kind of different industries. And I think that's a big point to make very clear.
What they're doing. So second point, revenue per monthly user is up 43% per user. That's big. That's a big number.
Because they're attracting the users are then staying on the platform and then spending more money with them. Yep.
Clearly, as they're getting more people, it's working out for them. Now the question.
And they're having 11 states turn profitable that they've launched that are 3-4 years old. After 2 years, the states turn profitable. More users spend more money with them. Okay, we're making some progress now.
The question becomes, going back to that bear case, is that going to sustain? How difficult is it going to be?
If you look at the history of the states that launched, they continue. If you look at the recent earnings, this is why you need to do research on the company. If you look at the recent earnings, they said that states that were launched in 2018 and 2019 this year still grew 50%.
Everybody knows DraftKings, like you said. And if you're not on DraftKings right now, it's probably because you don't want to be on DraftKings.
No, it's because it's not allowed in the states. Not all states have online sports betting.
So how are they going to...
Because the states come online.
Pull you in and say, like, I'm not on DraftKings. I have no interest in this. How are they going to attract me to go and do this?
And that's that's why the customer acquisition cost is so high.
Exactly.
Because in order to get a guy like Mo to join, he's got to be bombarded.
Yep.
Now, the other benefit, the other bull case for DraftKings, they're investing a lot of money into online stuff, so they don't have the big costs that sports books have, etc. So their gross margin.
That's a good point. That's a good point. I'll give them that one. That was a good point. They are going to have very good margins, more than sportsbook, because they're online only. Yep.
2.6% should be able to increase as time goes on.
Yes, and if you did your research, you would know that they're aiming for 40%. So yeah, that we're getting somewhere. That was a step in the right direction.
Right. And my whole goal would be that as all the players in this market, as this market totally unfolds, the smaller players will probably fall to the wayside, and the bigger.
Which has already been happening because FanDuel and DraftKings control the market. Yep.
And that's really the idea behind DraftKings and FanDuel. Let's just make sure we can control the market. That way, when all the other small side ones go away,
We're the guys.
we're the guys.
Yeah.
So the question becomes, what are you going to pay for a company like this?
Yeah, this is a tough one.
We have our stock analyzer tool, and our stock analyzer tool is so useful because it allows us to take the future value of we can estimate the future value of a company based on its future cash flow, right? You present value all the cash flow, and you come up with a price for the company. However, with a company like DraftKings, we have no profit.
Yes, so then that's even as a growth stock. All investing is thinking about what it's going to be in the future. Even with a company like Intel, you've got to realise what it's going to do in the future. You've got to work out, okay, Intel are losing the battle against AMD. So how much is that going to affect their revenue and profit? And can they turn it around in the future? Investing is thinking about even as a value stock, what is the future revenue and profit is going to be. The harder thing with growth stocks is a lot of them are unprofitable. So then you've got to realise what's the revenue growth going to be, and then when they do turn profitable, what is their potential profit margins going to be, and what profit are they going to generate. So it's exactly the same. So yeah, I think that is not really a valid point.
Over the last 5 years, we have no cash flow, so everything we do is going to be a guess.
Yeah.
But everything is a guess. Investing is a guess. You've got to guess how much Intel is going to generate in profit when it battles away with AMD, and can it turn it around?
And it's going to take them years before they're cash flow positive. I don't care what.
So this is, once again, you've got to look at the business, and you've got to understand since they launched in 2018, they've not had any states generating profit. It takes 2 years for the states to get profit. Now that we're in 2023, all the states that have been coming on in 2018, 2019, 2020, 2021, them states are coming profitable now, and that's why the losses are coming down, and they're getting closer and closer to generating profit. This is why they're going to be adjusted EBITDA profitable in this year. In Q4, they're going to be adjusted EBITDA profitable. So they are moving towards profitability.
They say.
And anything we put in here is assuming that starts
For reference as well, I think they'll get to a 10% profit margin in the next 5 years.
today. Profit. Let's say we make them profitable. That starts today.
Correct.
Day one.
So I look at it saying, guys, I'd love to be able to do some sort of assessment for this company, but I just can't. If you want to throw a few bucks at this, I'm not going to tell you not to, but for me, I look at it going, it's way too speculative. I'd rather wait for the industry to really throw all the people, all the crap to the side. They have an established business that can generate profit and cash flow. So, if you like the software, like what we did here, subscribe to the channel, and we're running a...
See, I don't have much of a problem with that. If you want to be investing into a company when they are profitable, if that's your investing philosophy, that's your investing philosophy. And you can follow that and just go, you know what, DraftKings isn't for me because it's not profitable, and I only invest in profitable companies, and that's my investing philosophy. 100%, if you're a value investor and that's your philosophy, put your hands up. Don't put your hands up and say, oh, I only invest in profitable stocks and everything else that isn't profitable is a company that is absolutely terrible. Because there's been plenty of companies that haven't been profitable that have been absolutely amazing. That's just a different type of investing. That's a growth investor. Now, with growth investors, it comes on that risk that you are investing in companies that are unprofitable, and there is that higher margin of risk that they have to get to that point of profitability. But you can't turn around and just say a company is bad because it doesn't make profit, because then you every single successful company at some point has been unprofitable. You've been missing. Look at Tesla. Tesla was a company that was unprofitable, did absolutely amazing. Amazon, company that was unprofitable, did absolutely amazing. So many of them. So you can't just disregard a company and go, oh, it's a trash company because it's not making profit. If it doesn't suit your investing philosophy, hold your hands up, go, yeah, it's not one for me. it could be in a few years. But don't then put it down because of that reason. So yeah, that's what I'd say on that.
A special $7 for 7 days on our software. You can risk $7 to see how awesome the software is, and it'll help.
Right, I think that's the end of the video because they're now promoting the free $400 a year program. So yeah, overall, just shows you that there was just too much number looking, not enough actual little bit of research into the company, seeing what's going on inside the company, and that would have dealt with a lot of the bear cases that was in this. So there wasn't really anything in this video that really kind of put me off DraftKings, and the fact that any bear case that was out there, I was able to strongly put a counter argument against, gives me a lot more confidence holding it. And yeah, I mean, obviously, once again, this is the kind of classic view of that, oh, it doesn't make any profit, so it's a bad company. Whereas actually, when you look in the fundamentals of the company, you can see here that the revenue growth is growing. You can see here the gross margins improving. They are now on the path to profitability. They are generating more states that are contributing profit, and then that will contribute to, you know, positive adjusted EBITDA this year, and then we move into profitability. And like I said, in the longer term game plan, I think that DraftKings will push up towards 50% gross margins. I think they'll put about 10% in that bottom line. And when you look at the company and how rapid it will go, and when you've still got states that have been launched 5 years ago, 4 years ago, and are still going at 50%, even when the company matures and all the states are online, all these states are still going to be in hyper growth mode for many years. So yeah, it's such a hot industry in the next 10 years. So yeah, overall, I think there was not many well researched points in here, and just too much looking at numbers, and some of the numbers were old numbers as well. And I think that when you're investing, you do have to do a little bit of research and not stare at just the numbers that they've done previously. The whole thing about investing is looking what it's going to be doing in the future. You've got to be valuing a company off its future growth. That's where it's going to be, not where it's been. You know, if you look at Intel 4 years ago and you started valuing Intel of what it had done previously, you'd be like, oh, it's an actual okay buy. But if you actually look at what's going on in the future and you realise the technology was falling behind the likes of AMD, eventually that's going to hit the profit revenue, boom, stock's down 61%. And that's why you got to be looking at the future of the business. So anyway, video there on DraftKings, a bit of a reaction video, and yeah, overall, I think it's just made me more of a bull on DraftKings really. So hope you enjoyed the video. If you could hit like button, if you're around here, subscribe. Catch you in a bit.